All right, so today we're going deep on a fascinating life insurance strategy,
Absolutely.
and it's called lump sum only.
Okay.
And basically the idea is, instead of making those
Yeah.
regular premium payments, you just kind of make one big one up front and then you're done.
Right.
We've got a case study to break down, and, it looks at this hypothetical 40-year-old guy, Jake Thompson,
Okay.
healthy non-smoker, the whole nine yards.
Right.
And it shows how this lump sum only approach could actually work for someone like him.
So what's really interesting here is this idea of essentially front-loading your investment.
Okay.
You're making one significant payment up front, and then you don't have to worry about those ongoing premiums anymore.
Yeah, and I saw in the case study they're talking about like $150,000.
Yeah, 150,000 split into two payments.
Okay, so not exactly chump change or anything.
Right, definitely a sizable investment.
So I guess the question is, what makes this strategy so appealing that somebody would even consider putting down that much money right off the bat?
Well, the case study really zeroes in on the potential for flexibility and long-term growth.
Gotcha.
And to help visualize this, they've actually included a chart.
Ooh, a chart.
Yeah.
I love a good visual.
Me too, and this one is really helpful.
So what is this chart showing us?
Basically, it tracks both the cash value and the death benefit of the policy over time.
Okay, so just as a quick reminder,
Sure.
with life insurance, you've got that death benefit, the payout to your beneficiaries if you pass away.
Exactly.
But then there's also that cash value component that builds up over time.
Right, it's like a savings account built right into your policy.
Yeah, exactly.
And what's really cool here is that the chart shows how both the cash value and the death benefit, they keep growing over the years, even though Jake's not making any more payments after that initial lump sum.
Hold on. So how does that growth happen if there are no ongoing payments?
That's where the internal rate of return comes in.
Okay, the IRR.
Yeah, exactly. It's basically a way to measure how profitable an investment is.
Right.
So in this case, the IRR takes into account that initial lump sum payment and the projected growth of both the cash value and the death benefit.
Okay, I'm following.
The higher the IRR, the better the potential return.
Makes sense. But I'm also thinking, committing such a large sum up front, wouldn't that make this whole strategy kind of inflexible? Like, what if Jake's financial situation changes unexpectedly?
That's a really important point to consider.
Yeah.
While the case study highlights that set it and forget it aspect of a lump sum payment,
Right.
it's super important to think about potential downsides.
For sure.
And one of those is liquidity.
Okay.
Having that much capital tied up could really limit your options if those unexpected expenses pop up.
Yeah, that makes sense.
And on top of that, there's also the opportunity cost to think about,
Uh-huh.
that $150,000 could potentially be invested elsewhere, maybe with even higher returns.
Exactly.
So it's all about weighing the potential benefits of this strategy against other investment opportunities and your overall financial goals.
So it sounds like this lump sum only strategy could be a good fit for someone who has a good chunk of capital up front and they're looking for a more hands-off approach.
I think that's a fair assessment.
But it's definitely not a one-size-fits-all solution.
Absolutely not. And, while this case study focuses on that lump sum,
Yeah.
it's worth remembering that there are other ways to structure a life insurance policy.
Right.
Like you could opt for higher premium payments for a certain period, and that might offer similar long-term growth, but with more flexibility.
It's like there's a whole choose-your-own-adventure thing going on with life insurance.
I like that.
Many paths to explore.
For sure.
So as you're thinking about your own financial planning,
Yeah.
here's something to chew on.
Okay.
Could making a single strategic payment be the key to unlocking your long-term life insurance goals? Or would a different approach be a better fit?
That's the question, isn't it?
It is, and the choice, as always, is yours.
Absolutely.
Thanks for diving deep with us.
Of course, my pleasure.
Until next time, happy planning.
See ya.